Geopolitical uncertainty can cause short-term market volatility, but historically, it doesn't have lasting effects. And unlike the 1970s, the US now has a sufficient supply of domestically produced oil. I'm Michael Drozd, CIO for LaSalle Street. This is A View from the Street. Stay tuned to learn why near-term unpredictability and uncertainty can create opportunities for long-term investors, and why asset classes outside of traditional stocks and bonds may continue to perform well in these types of periods. The unpredictability of geopolitical tensions further supports portfolio diversification across asset classes and away from concentrated portfolio positions. In the near term, gold and oil are effective hedges against geopolitical risks, further supporting the case for strategic asset allocation to gold within diversified portfolios. And if we review the last 20 years, including major geopolitical tensions, on average, gold has outperformed US stocks and the US 10-year Treasury by over 3.5%. Expanding the role of gold beyond just a geopolitical hedge reveals its potential in a higher inflation and higher interest rate environment. Gold continues to offer diversification benefits similar to those provided by traditional bonds over the past 2 decades, particularly due to its lower correlation with equities. This suggests that the 40% allocation to bonds in a portfolio should be reconsidered. Reviewing 5-year historical correlation since 2020 shows that adding gold, cash, absolute return strategies, and market neutral strategies have all enhanced portfolio diversification, especially during periods of equity market volatility. The shift from the past 2 decades of low growth and inflation is not unprecedented. In fact, when we expand our historical return data set over the last 100 years, we find that the last 2 decades were an anomaly in terms of correlation. Statistically, negative correlations between asset classes means that when one zigs, the other zags, creating diversification potential. And in an environment where simply owning the market passively may not work as well in comparison to prior decades, being active across asset classes may continue to provide complementary diversification aspects to multi-asset class portfolios. In conclusion, with the relationship between stocks and bonds shifting from negative to positive, and bonds potentially impaired by a rising term premium, the days of the straightforward 60-40 portfolio may be in question. Thanks again for tuning in. Be sure to tune in to our next episode of A View from the Street.